Okay, welcome to Chapter 1, Accounting in Action. This will be your first PowerPoint slide and first chapter for the course. So it's definitely pretty important. Actually, chapters 1 and 2 are the most important in the class. So let's get started. Quick study objectives of the course, and you'll see these same objectives in your textbook. Same objectives: what is accounting, the building blocks of accounting, basic accounting equation, very important. Using the basic accounting equation, you'll have transaction analysis, which is important. Um, Financial statements, income statement, owner's equity, balance sheet, statements of cash flow. Those are four major statements in accounting. So the purpose of accounting is to, one, identify, record, and communicate the economic events of an entity or organization to interested users, and we'll see that interested users can be both internal and external users. These three activities: identification, select economic events, transactions, whether you purchase something, you pay salaries. Um, the second is recording. We record, classify, and summarize all these transactions, and we communicate them by preparing financial statements, whether it be balance sheets, income statement, statement of owner's equity, or the cash flow statement. So as far as internal users, we have management, human resources, finance, and marketing departments. As you can see by the blue circles. Broad group of users, both internal and external. The external will be IRS, investors, labor unions, creditors, the SEC, and customers. The SEC you'll see is more of the governing agency for generally accepted accounting principles. That's GAAP, GAAP, as you'll see later on. So again, we have external users and internal users. So this slide looks at common questions asked by each user. So as far as, can we afford to give our employees a pay raise? That user will be human resources. So basically, human resources uses accounting data to answer that question. Did the company even earn a satisfactory income? That'll be investors, more external user. Do we need to borrow in the near future? Company management, internal user. Is cash sufficient to pay dividends to the stockholders? That'll be another internal department, which will be finance. And the last two: what price for our product will maximize net income? Marketing. And will the company be able to pay its short-term debts? And that'll be other creditors. Banks loan money to the company, to the customers. Their customers, which are basically, say for example, any company. And they're going to look at financial statements, the balance sheet and the income statement. Income statement shows net income. Creditors are going to say, hey, is this company making money? So discussion question 1: accounting is ingrained in our society and is vital to our economic system. Do you agree? And the answer is yes. As far as ethics in financial reporting, I'm sure we all heard of Enron, WorldCom. Accounting gives management of a company basically the chance to use their own decisions by using their own estimates, which can very well lead to very subjective outcomes. And at times, management can make bad choices. And as a result, you have these scandals above. Review question: ethics are the standards of conduct by which one's actions are judged as right or wrong, honest or dishonest, fair or not fair, and it's going to be all these options. Okay, the building blocks of accounting. Various users need financial information, which is these financial statements: balance sheet, income statement, statement of owner's equity, statement of cash flows, and note disclosure. What note disclosure is, that's basically every time we have a set of financial statements, a set of audited financial statements, GAAP, generally accepted accounting principles, requires certain disclosures, which will be in narrative format, in written format, as if you were writing a paper, explain certain terms and stuff, not just in quantitative, as you would see in the financial statements, but more qualitative as far as a summary. So organizations involved in standard setting, we saw the Securities and Exchange Commission, Financial Accounting Standards Board, FASB, also known as FASB, and we also have International Accounting Standards Board. International, IASB, and Generally Accepted Accounting Principles are currently being meshed together, so we have one unified set, and that's still going on as we speak now. Cost principle. This is pretty important. Basically dictates that companies record an asset at its cost. So basically, if you purchase equipment, say at $3,000, and the market value a year later is $7,000, we're not going to record it at $7,000. We record it at what we purchased it for originally. So the issue is reported at cost when purchased, and also over the time the asset is held. So basically, if we keep it at cost, we could be understating the value of our asset, but it's more reliable. It's more reliable because we have a set number, because we know what we paid for it. Market data can be subjective, appraisals and what have you. So the cost principle is more of a conservative approach. It can easily be verified, whereas market value is often subjective. Fair value information may be more useful, like I originally said, but again, it's subjective, and what one person says can differ from what another person says. Many assumptions. This starts the assumptions. Monetary unit assumption, that basically states that in accounting records, we express the information in terms of dollar amounts. Economic entity assumption. This requires that activities of the entity be kept separate from the owner's activities. So basically, if I have a company, ABC company, and I pay something, I pay my mortgage on my home, I don't record that in my business financials, and vice versa. We keep them separate. Different forms of business ownership are proprietorship, partnership, and corporation. Okay, we'll have a breakdown of each. So proprietorships, generally owned by one person, often small service type businesses. And again, you can have outliers and exceptions. These are just generally general guidelines. Owner receives any profits, suffers any losses, and is personally liable for all debts. Key term there, personally liable. Partnership, owned by two or more persons. Or that can be entities as well. But for this PowerPoint, let's just assume it's owned by two or more persons. Often retail, service type businesses. Generally unlimited personal liability. And they have a partnership agreement. It basically shows if you and I are in a business together and we're the owners, we can have it set where, as far as profits, you get 60%, I get 40%, and the same thing with losses. I get 40%, you get 60%, or it's 50-50, or 80-20, however you guys set it up, or however we set it up. Corporation, ownership divided into shares of capital stock. We'll see this more about the corporation later in the course. I believe that's more like week 5. It's a separate legal entity organized under state corporation law, and each state has differences in their law, but also have some of the same characteristics. Limited liability. Notice that limited liability, whereas the partnership and the proprietorship have unlimited personal liability. So for the partnership, generally unlimited personal liability. Last point, in proprietorship, personally liable for all debts, whereas the corporation has limited liability. So let's check out a review question. Combining the activities of Kellogg and General Mills would violate the A, cost principle, economic entity assumption, monetary unit assumption, or ethics principle. Combining the activities. That's going to be economic entity assumption. A business organized as a separate legal entity under state law having ownership divided into shares of stock. Keyword, shares of stock. You only see that in a corporation. Okay, so the basic accounting equation, this is really important. Basic accounting equation says that assets equals liabilities plus owner's equity. And we'll actually get a good overview of this in the transaction analysis. I think that's in a few slides moving forward. But this is the actual underlying framework for recording everything in accounting. Assets are claimed by either creditors or owners. Claims of creditors must be paid before ownership claims. So that's basically if the company is going out of business, we pay these first, then we pay the claims on the assets from the owners second. So these are always our first priority. And it's key here to just remember assets are claimed by either creditors, which are liabilities, or assets are claimed by owners. These both represent claims on these assets. Good to know. So assets are resources a business owns, provides future services or benefits, and examples are cash, supplies, equipment. We'll see that we have accounts receivable, petty cash, anything a business owns, and the keyword provides future services or benefits. That's the underlying definition of an asset. Liabilities. Claims against assets. Example, debts, obligations, whether it be salaries payable, mortgage payable, accounts payable. Creditors, party to whom the money is owed. They don't have example accounts payable, notes payable. And we'll see examples throughout the rest of the PowerPoint presentation. You'll definitely see them in your text. Owner's equity. Ownership claim on total assets. Referred to as residual and equity. Keyword residual, know that for the exam. Examples are capital, drawings. Drawings are, you'll see that account. That's basically when we deal with a partnership or a sole proprietor, not a corporation. That's how the owners take money out. And you'll see with the corporation, that's called dividends. So here's the basic accounting equation. Assets equals liabilities plus owner's equity. Expanded is assets equals liabilities plus the breakdown of owner's equity includes owner's capital, owner's drawings, revenues, and expenses. So revenues add to owner's equity, expenses are deducted from owner's equity, same thing with drawings. So revenues are the result from business activities entered in for the purpose of earning income. Note that for the exam, we'll read that again. Revenues result from business activities entered into for the purpose of earning income. Common sources of revenues are sales, fees, services, commissions, interest, dividends, royalties, rent. Sales, fees, services, that's basically all the same thing. Commissions could be the same thing as well. Expenses are the cost of assets consumed or services used in the process of earning revenue. Again, this is all the core business functions, the process of earning revenue. Commissions, common expenses are salaries expense, rent expense, utilities expense, tax expense. All of these expenses are going to be found on the income statement. Expenses are an income statement item. So we'll have revenues minus expenses equals net income. Transactions are the business's economic events recorded by accountants. So if I purchase equipment, if I transact with a customer and sell something, not all activities represent transactions. An example of this would be if I hire you, that's not a transaction. That's a business decision, but however, it doesn't get recorded in financial statements. So each transaction has a dual effect in the accounting equation. Remember we saw assets equals liabilities plus owner's equity. It's talking about the dual effect there. So what it does on one side, the asset, um, it's going to affect the other side or affect the same side. So, but the addition of assets will equal the addition of liabilities plus owner's equity, and we'll see that in the transaction analysis. Okay, here's an example. Are the following events recorded in the accounting records? So we have supplies are purchased on account. Think about that. Do we record that or do we not record that? An employee is hired and the owner withdraws cash for personal use. So the criteria for either recording or not would be, is the financial position, assets, liabilities, or owner's equity of the company changed? So we would definitely record the purchase of supplies on account. Hiring of employee, we don't record. And we record the withdrawal of cash. In February 2010, Paula King invested an additional $10,000 in her business. King's Pharmacy, or her name of the business is King's Pharmacy, which is organized as a proprietorship. King's accountant, Lance James, recorded this receipt as an increase in cash and revenues. Is this treatment appropriate? Why or why not? So is this really a revenue or is it a contribution into the company? So it wouldn't be proper. The transaction involves the receipt of cash, but it doesn't represent a revenue. Remember, revenues are the gross increase in owner's equity resulting from business activities, keyword business activities, core business activities, entered into for the purpose of earning income. This transaction is simply an additional investment made by the owner. Okay, transaction analysis. This will give you a great overview of the accounting equation and the dual effect that we just mentioned before. Ray Neal decides to open a computer programming service, which he names SoftBite. On September 1st, 2010, he invests $15,000 cash in the company. So looks like we found an error there. The effect of this transaction on the basic equation is cash, increase in cash at $15,000, owner's equity increase at $15,000. Notice that one side, assets, and the second side, the right side, liabilities plus owner's equity, they're both in balance, and that has to happen on every single transaction. That's the dual effect of the accounting equation. Transaction number 2, as we can see, here's the old balance of transaction number 1. SoftBite purchases computer equipment for $7,000 cash. So we use cash, but we gain equipment. So this only affects the left side of the accounting equation. So we subtract $7,000 of cash, but we add $7,000 worth of equipment. The net effect $15,000, and that's adding this old balance. The net effect is $15,000 because cash, the current balance in cash is $8,000. Current balance in equipment is $7,000, and the owner's equity is still $15,000. So we're good over here. Liabilities plus owner's equity is $15,000. Assets equals $15,000. Still in balance. Transaction number 3: purchase of supplies on credit. SoftBite purchases $1,600 from Acme Supply Company computer paper, and and other supplies expected to last several months. So since it's expected to last several months, we're going to include this as an asset. So as we can see in the red, we increase the asset by $1,600, and something new, accounts payable. Since we didn't pay for cash with cash, we're going to pay on account, and you'll see that term on account. It's actually not used here, but anything that's not used in cash, if we gain something, it's either going to be a reduction in cash or an increase in a liability. So then that's the case here. And then as you can see, 16.6 in the bottom adds up, 16.6 liabilities and owner's equity add up. So we're still in balance here. Transaction number 4: receives cash from customers for programming services it had provided. So you'll see the increase in cash, and you'll see the increase in revenue. And again, we're still in balance, 17.8, 17.8. Fifth transaction: purchase of advertising on credit. On credit, on account, think of that as accounts payable. SoftBite receives a bill for $250 from the Daily News for advertising, but postpones payment until a later date. So basically, and we'll see this down the road in chapter 2, journal entries, where we're gonna have an expense. We didn't pay anything yet, so we're gonna incur an expense for $250, which reduces owner's equity, and we're gonna increase our liabilities by $250 by postponing that, which is gonna be accounts payable. Okay, next slide. Services provided for cash and credit. SoftBite provides $3,500 of programming services for customers. So basically, that's right. They're increasing their revenue. The company receives cash of $1,500 from customers and it bills the balance $2,000 on account. So this is this is the first time we're going to see something called accounts receivable, which is an asset, and it's just basically just a claim to receive future cash. So by this transaction, we're going to increase our cash by $1,500, increase another asset called accounts receivable for $2,000, and see that add these up. That's going to be $3,500, which we're going to increase our revenues. So again, down here, totals, we add up, we're in balance, and that's your check figure. And again, if that doesn't add up, that means we did something wrong up here. Payment of expense. So SoftBite pays the following expenses in cash for September: store rent, salaries for employees, and utilities. So add them all together, and we deduct cash by $1,700, and this affects our owner's equity, and it affects it by decreasing those three respective amounts. So we have the cash reduction and the expenses, and again, add them all up, all those transactions, the total of all 7, we get 19.6. We're in balance. Transaction number 8, payment of accounts payable. Payment of accounts payable is what we're going to do here is we already have an accounts payable on the books. So we already have a liability on the books. So by paying this, we're going to reduce that liability, but also we're going to reduce cash. As you can see down here, cash we're reducing by $250. However, we're also improving our overall net worth of the company by subtracting or reducing a liability. Reducing liabilities are good. Receipt of a cash on account. So SoftBite received $600 in cash from customers who have been billed for services. So what we're going to do here is we're going to receive the cash for $600, and we're going to subtract $600 from accounts receivable because they no longer owe us this money. Transaction number 10, and I believe this is the last one for transaction analysis. Withdrawal of cash by owner. Ray Neal withdraws $1,300 in cash from the business for his personal use. $1,300 is subtracted from cash, and drawings reduces owner's equity. And again, in one of the assumptions we had spoken about earlier in the slides is we don't mix personal and businesses together. We separate those, and this is a good example of, hey, I want money out of the business for my personal use. This is the transaction that happens. Here is an overall summary of all these transactions. You will have a homework problem. This is a great resource to use for your homework problem. See the breakout up here. We have assets equals liabilities plus owner's equity, and here's an example of all the assets. Here an example of the liabilities that we use, and this is much more liabilities, but we only use accounts payable in this summary over here. Owner's equity involves capital, drawings, revenues, and expenses. And down here, 18.5, perfect. Okay, so companies prepare 4 financial statements from the summarized accounting data. So we have the income statement, owner's equity statement, balance sheet, and statement of cash flows. Review question: net income will result during a period when assets equals liabilities, assets exceed revenues, expenses exceed revenues, revenues exceed expenses. So net income will result during a time period when revenues exceed expenses. It is not A because the assets and liabilities are found on the balance sheet. Net income is found on the income statement. Assets, it's not B because assets exceed revenues. Assets are balance sheet. We're looking for all income statement items. Could be C and D, but expenses exceed revenues. That means we have a net loss. Revenues exceed expenses. We have a net income. We have net income right here. And here's an example of an income statement. Income statement reports the revenues and expenses for a specific period of time. Key word right there, specific period of time. Balance sheet is going to be a point of time. So this specific period of time is, see up underneath where it says SoftBite income statement for the month ended September 30th, 2010. So that's from September 1st to September 30th. If this was an income statement, a year-to-date income statement, and the fiscal year was the calendar year, this would be from January 1st to September 30th, which would be a period of time. Net income is revenues was when you have revenues exceed expenses, and that you'll see that in this case here. Net loss is just the opposite. So let's go through the income statement. Revenues. We have one category of revenue, which is service revenue, $4,700. Expenses, we have quite a few. We have salaries expense for $900, rent expense for $600, advertising expense for $250, and utilities expense for $200. Total expenses are at $19,500. Total expenses are less than service revenue. So that difference is net income of $2,750, and we get these numbers from that transaction analysis for those 10 transactions we just completed. This is the net result, the end result. Let's look at the income statement going into the statement of owner's equity. So that $2,750, the income statement is the first financial statement that you'll make because this net income needs to go to the owner's equity statement. As you'll see by number 1, it's flowing in to the owner's equity statement. And let's go over that really quick. Basically, you start with the owner's equity statement. R. Neal's the owner, so R. Neal capital as far as September 1st was 0. We had investments of $15,000, and I believe that was the first transaction we went over. Net income is $27,500. Add both those together, $17,750. We had drawings of $1,300. I think that was the last transaction we had, and net result will be the capital balance at September 30th, which is $16,450. So the owner's equity statement that we just went over in the previous slide, it indicates the reasons why owner's equities have increased or decreased in a period, and these reasons can be affected by investments and net income or net loss and drawings. So again, we have investments, net income or net loss, and drawings, and that affects the owner's equity statement. So the ending balance in owner's equity is needed to prepare the balance sheet. So first we have the income statement that we prepared, owner's equity statement. Now we prepare the balance sheet, and we can see SoftBite balance sheet. All these financial statements have a three-line heading. Make sure you do this for your homework. That's very important. Always have 3 lines. Balance sheet is a point in time, not a period in time like the owner's equity statement and income statement. This is a point in time. It's only have one date. Think about it as taking a picture, a snapshot. Hit the button, it's just one shot. Assets. The accounts assets are cash, accounts receivable, supplies, equipment, and again, these financial statements are the result from the transaction analysis that we just completed, those 10 transactions. So cash, $8,050, accounts receivable, $1,400, supplies, $1,600, equipment, $7,000, totals $18,500. And you'll note that there's no negative numbers ever in financial statements. Good thing to remember. Okay, now the second part is liabilities plus owner's equity. Remember we had the basic accounting equation, assets equals liabilities plus owner's equity. Notice how these two balance? That'll be always be the case. And if it's not, we did something wrong in those transaction analysis or journal entries, as we'll see in chapter 2. Liabilities 1600, owner's equity is 16450, and we got that from the ending balance up here on the owner's equity statement. So we balance here total assets equals total liabilities plus owner's equity. And it just gives you another overview of the balance sheet. Okay, the last financial statement is a cash flow statement. I'm not going to really go much into the cash flow statement in this week, more of an elementary week or an introductory week. Cash flow statement will be discussed more detail either in the last week of the class, or depending on how I make that class, I might just take that out of the class totally more for a second level class. But statement of cash flow, the cash balance, statement of cash flow, use that cash balance for cash at the end of the period. Statement of cash flow just shows the inflows and outflows of the cash for a period of time. So basically, the only financial statement that's a point in time is the balance sheet. Everything else is for a period of time. Make sure you know that for the quiz. Statement of cash flows, information for a specific period of time. It answers questions such as where did the cash come from, what was cash used for, what was the change in the cash balance. And we'll see, and the cash flow statement has 3 separate activities, which are called operating activities, investing activities, and financing activities. So as far as a review question, which of the following financial statements is prepared as a specific date? And this is really important. Again, this is a quiz question, so let's make sure we get this correct. And if you're watching the video, you will. So is it the balance sheet, income statement, owner's equity statement, or statement of cash flows? Balance sheet is the correct answer. Specific date. Discussion question. The company's net income appears directly on the income statement, which we saw revenues minus expenses equals net income. So a company's net income appears directly on the income statement and the owner's equity statement, and it is included directly in the company's balance sheet. Do you agree? Let's think about that. So the answer is yes. A net income does appear on the income statement, which is a result of subtracting expenses from revenues. It also appears on the statement of owner's equity. It is shown as an addition to the beginning period of capital, like we went over before. Indirectly, net income of the company is also included in the balance sheet. It's included in the capital account, which appears in the owner's equity section of the balance sheet. Good question. And again, I believe this is the last slide. Accounting career opportunities. You have public accounting, careers in auditing, taxation, serving the general public, private accounting, opportunities with the government, forensic accounting, or you know what, just accounting overall is good for any management position. You'll really get a good grasp on even if you're not really an accountant, just the accounting, the language of business is good for just about anything. You just want to be competent in your financial abilities. I mean, you don't have to be a financial guru, but if you're going to own your own business, you definitely want to understand accounting, different financial statements, and the same thing with investing in companies. You know, again, I recommend that all students, regardless of their tenure in school or age group or just major, just understand the basic components of accounting. And I believe this concludes chapter 1. Thank you.